So we now proceed with the cash management. So we have done the formal cash management model. What we should now deal with is meant to be. What we should now deal with is meant to be Miller and Oro. You are to start on the Miller and Oro cash management model. So we had written some notes on that. We draw the diagram. Yeah, so you are to look at some of the questions. You are now meant to look at some of the questions in relation to Miller and Oro cash management model. You are meant to do a question on the Miller and Oro cash management model. So let us get the first question in relation to the Miller and Oro's. We can now get the first question in respect to the Miller and Oro. So the first question I would like us to do. So the first question I would like us to check. So we can get a question on the Miller and Oro. We can now get a question on that page. So the first question I want us to check should be May 2018. So go through the question for May 2018. Question number 1, part C. So maybe that should be the first question. So let us first check the one for May 2018 before we go to that one. So let us start with the one for May 2018. Question number 1, part C. Before we go back to the one I had specified in the class last time. So you shall first check the question for May 2018, question number 1, part C. So that question 1, part C, it reads that the question number 1, part C should be on page 44. So when you check on page 44, there is a question number 1, part C. So the question number 1, part C reads that Mandani Enterprise maintains a minimum cash balance. It maintains a minimum cash balance of shillings 10,000. It maintains a minimum cash balance of shillings 10,000. The standard deviation of the daily cash flows is shillings 2,500. Shillings 2,500. The transaction cost of each marketable security is shillings 20. Shillings 20. So the interest rate of the marketable security is 9.2%. The interest rate on the marketable security is 9.2% per annum. Assume there are 365 days in a year. Assume there are 365 days in a year. So required using Miller and Oro model of the cash management. Determine Roman letter 1 is the optimal cash balance. Roman letter 2, upper cash limit. Roman letter 3, average cash balance. Then also Roman letter 5, the spread. So we start with the Roman letter 1, which is supposed to be the optimal cash balance. We go to the Roman letter 1. Roman letter 1 is the optimal cash balance. Go to the Roman letter 1, which is supposed to be the optimal cash balance. So to calculate the optimal cash balance is the same as C. Sorry, it is the same as Z. So Z, it is supposed to be given by 3, like that. Then So it will be equal to 3. So this one is the transaction cost per transaction. So the transaction cost of each marketable security is 20 shillings. So multiplied by 20. So the standard deviation was given as 2,500. So you square the standard deviation in order to get the variance. For us to get the variance, square the standard deviation. Then we divide by 4. I is the interest rate. So that interest rate, they gave you 9.2% per annum. It's the same as 0.092, but this one is per annum. That rate I said is the daily interest rate. The question has said, we assume there are how many days in a year? Yeah, so that rate divided by 365 days, so that you get the daily interest rate. You rest the power of 1 over 3 plus L. L is the minimum cash balance, which is 10,000. So now you compute that portion so that we see what should be that optimal cash balance. So that we get now the optimal cash balance. So that you get now the optimal cash balance. So you give me the figure that you have calculated so that I can be able to know what you have computed. So give me the figures that you are coming up with. $17,191.6. So you can have it as 192. So you are getting which figure? I've been told it's 17,192. I've been told it is 17,192. Online, manipulate your figures. Online, give me your figures. You are getting which values? If you don't give me the figure, you may not know whether it is making sense or not. They are not communicating at all. Anyone who has computed, kindly give me the figure that you are getting. If not, you let me know so that we see how to assist. Because if you keep quiet, I may assume you have understood. Amma, the figure you have calculated is correct. So, can we go to Roman letter 2 now that you are not giving me the figures? Roman letter 2, they were asking me to compute the upper cash limit. 17,192 like that. So I hope you are getting that value. It is very difficult to assist people who don't want to communicate. So me, I don't know whether you are in class. So are you getting that figure of 17,192? I don't know that people they are in class. Because no one is giving me what they have calculated. I'm asking them whether they are getting that figure. No one is responding. So I assume that is the figure you got. So let us now go to the Roman letter 2. We go to the Roman letter 2. Roman letter 2, they wanted you to calculate the upper cash balance. Roman letter 2, we come up with the upper cash balance. So to calculate the upper cash balance, had given you a formula for that, how to get the upper cash balance. So Roman letter 2, we compute the upper cash limit. Roman letter 2, we compute the upper cash limit. So from the formula I gave you, H represents the upper cash limit. So it will be 3Z minus 2L. So H will be 3Z minus 2L. So this will be the same as 3. So Z is what you got as 17,192. Then you minus 2L. So L is the minimum cash balance, which is 10,000. So that should now be able to give you the upper cash limit. Now be able to give you the upper cash limit. So after that, now we go to the Roman letter 3. Roman letter 3 is the average cash balance. We now go to the Roman letter 3 where we get the average cash balance. So Roman letter 3, to get the average cash balance, for Z minus L divided by 3. So Z was 17,192. So L is the minimum cash balance, which is 10,000 divided by 3. So that is now our Roman letter 3. So after that, we now go to the Roman letter 4. Roman letter 4, they were asking you to compute the spread. Roman letter 4, now you calculate the spread. So Roman letter 4 should come up with the spread. So good. So spread is H minus L. So the spread is the upper limit divided by the lower, minus the lower limit. So that upper limit was which figure? 31, 576. So the lower limit is 10,000. So that should be able to give you the spread. Should be able to give you the spread. So now we go back to the question we had specified. We had said in the last class it was which city? So we go to November 2020. Question 3, I'm sorry, it's on page 28. So we now go to November 2020. Question number 3, part A. November 2020. Question number 3, part A. November 2020. Question number 3, part A. So that's November 2020, question number 3, part A. Question 3, part A. The question reads that the following information relates to Baobab traders. Note number 1, minimum cash balance is 8,000. Note number 2, variance of the daily cash flow is 4 million, equivalent to the standard deviation of 2,000. So here the question has given the standard deviation of 2,000. When you square 2,000 is when you get a variance of 4 million. Note number 3, the transaction cost of buying or selling the securities is 50. Note number 4, interest rate is 0.025% per day. So required using Miller and Oro model, using Miller and Oro model of managing cash, determine the following. Roman letter 1, the spread. Roman letter 2, upper cash limit. Roman letter 3, return point. Then Roman letter 4, they wanted you to make the decision. So in that question, you start by answering the Roman letter 3 before you go to the Roman letter 2. Then Roman letter 1 is our last part. You see the question we have done. Now, we cannot answer the spread unless we have answered Roman letter 3 and Roman letter 2. So we start off with the Roman letter 2. Yeah, 3. Yes, may indicate your diagram. You see the diagram that you do. It is the return point or the target or optimum. It is the return point or the target or the optimum. That is the same as our Z. So we start to the Roman letter 3. Before you go to Roman letter 2, then the spread should be Roman letter 3. The spread should be the last one. The spread should be the last one. Spread should be the last one. So return point is the same as the optimum. So Roman letter 1 is the return point. Return point is the same as Z. So Z should be equal to 3B, then the variance 4I. Then so B is the transaction cost per transaction, whereby they gave you in the note number 3 as 50. So variance is given. You see the standard deviation. When you take 2,000 squared, you will get 4 million. So the standard deviation is given. So I was given, you see the note number 4. Interest rate is 0.02% per day. It has been given per day. Remember, if they give you per annum, like the previous question, we divided by the number of days in a year to get per annum. But this one is already per day. So when you take 0.025, it will be the same as 0.0. Another 0 like that. This like that. There are 3 zeros. Yeah. Then now this, so this time it is given per day. That's why I'm not dividing by the number of days in a year. They have already given you per day. Then now you add, not number 1, minimum cash balance was given as 8,000. So that should now be in a position to give you the average cash balance. So this one should give us around which figure? 16. So I'm told it is 16, 434 like that. Are we getting 16, 434? Yeah, they are saying they are getting the same figure. So apart from that, now we go to the Roman letter 2, the upper cash limit. So Roman letter 2, upper cash limit. So upper cash limit, remember, it is the same as H. So H is supposed to be given by 3Z minus 2L. It should be 3Z minus 2L. So it is 3. So Z is 16, 434. And we subtract 2L. So L is 8. So now we go to Roman letter 3, Roman letter 1, where they were asking you now to get the spread. So the spread is going to be H minus L. So H, you have gotten which figure? 33.
Oh, sorry, 25.
Sorry?
25. H. 33,000.
3. Is that 3,000?
23.
302 like that. So you subtract 8. 25, 300 and So are we in agreement up to that point? Online, I hope we are in agreement up to that level. Yeah, so now apart from that, let us also get the average cash balance, even though the question did not ask. I also want us to calculate. The other question, they had asked you to get the average cash balance. So let us also see how to compute average. Cash balance. So average cash balance from the information I've given you, it is 4Z minus L divided by 3. So Z was how much? 16. So after that, we should now also go to the Roman letter 4, where they were asking you to propose a decision rule for each cash management of the company. So let us now go to the decision rule. We can now go to the decision rule. Let us now go to the now go to the decision rule. So when it comes to the decision, we require 3 points. We require 3 points. The first one is H. So remember H. H was 30 what?
33.
Was that 3, 302. That was 16. 16, 434. And L was what? So you want now to make the decision. So normally in our business, cash should be at this point. So in case it goes above this, up to the upper limit, that excess amount, invest in the marketable security. But if it reduces to this level, sell your securities to get cash to go back to this point. But if cash is along that level, there will be no decision to make. So let us start with the first decision. We start off with the first decision. So first decision, you can summarize that when the cash balances increases up to the upper limit. When the cash balances increases up to the upper limit, i.e. H, then the company should invest. Shillings H minus Z. The company should invest shillings H minus Z. Shillings H minus Z. That is 33,302 minus Z. Z was 16,434. So how much is that difference? It's 19.
16, 68.
Sorry?
68.
16, 8, 68. So we are saying that it should invest shillings H minus Z. So you write that figure and also that figure of 16,868. The 16,868. So should be invested, should invest in the short-term marketable security. So after writing the figures, let's say invest in the short-term marketable securities. Should invest that excess in the short-term marketable securities. So invest in the short-term marketable securities. That's now the first decision. The second decision is that when the cash balances reduces up to the lower limit L, when the cash balances reduces up to the lower limit L, if the cash balances reduces up to the lower limit L, then the company should convert. Shillings Z minus L. The company should convert shillings Z minus L. Should convert shillings Z minus L, i.e., so Z is 16,434, L is 8,000. So that figure should be 8,434.
Yes.
Yeah, so it should convert that shillings from the short-term marketable securities, into cash, And finally, decision 3 is that if the cash balances are along the optimum limit, if the cash balances are along the optimum limit, i.e. at Z, so Z is equal to 16,434. At Z, that is 16,434. Then no action should be taken. So that's now how you are meant to make the decision. So one more last question before we move out of that part. One more last question before out of that area. So one more last question before we conclude on that. So this one should be December 2014. December 2014, question number 5, part C. December 2014, question number 5, part C. So it should be on page 79. When you go to page 79, you'll get the question for December 2014, question number 5, part C. There is Question number 5, part C. Question number 5, part C. So that question 5, part C, the question number 5, part C, you check on page 79. So the question reads that Wanga Limited maintains a minimum cash balance. Maintains a minimum cash balance of shillings 1,500,000. The standard deviation of the daily cash flows is 800,000. So the annual interest rate is 12%. The annual interest rate is 12%. The transaction cost of buying and selling of the marketable securities is shillings 200 per transaction. Assume that 1 year has 365 days. So required using Miller and Oro, using the Miller and Oro cash management model, determine Roman letter 1 return point, Roman letter 2 average cash balance, then upper cash limit, then you'll also compute the spread. So we start off with the Roman letter 1, the return point. We start off with the Roman letter 1, which is supposed to be the return point, which is supposed to be the return point. So to calculate the return point, which is supposed to be Z, so return point which is supposed to be Z. Remember, it is 3p divided by 4i. So rest the power of 1 over 3. So B is the transaction cost per transaction. The question had given you 200. Then the variance. The question gave you the standard deviation of the daily cash flows. So standard deviation of the daily cash flows is given as how much? So I think you need to square that figure to get the variance, because they gave you the standard deviation. Then we divide by, so interest rate is given per annum, but we require per day. Annual interest rate, they have given you 12%, but we require it per day. So you take 0.12. They have said you assume that how many days in a year? 365, like that. Then rest the power of 1 over 3. And now you add the minimum cash balance is 1.5 million. So get that figure. So get the value. So once you get that value, I will also require you to go to Roman letter 2, Roman letter 3, then Roman letter 4, you can put there the spread. You will also include the Roman letter 4 as the spread. Before now, we move out of that part of the cash management. So you include there the Roman letter 4 as the spread. The spread. Also, you can, just the spread. So see whether you can get those figures correctly before we move out of that part.
Yeah. Program excellence. 괜찮아지?
So that is now all about the cash management. That will now be all about the cash management. So we have finished the question. So online, now I want us to go to page 5 in your notes. So after the cash management, the next item in your notes, the handout are given you. The next item should be debtors. Debtors or account receivable. Debtors or simply the account receivable. So now, you look at the debtors or simply the accounts receivable management. Now got the debtors or simply the accounts receivable management. So when you go through the handout, so we are on page 5. So on that page 5 of the handout, they were saying that debtors or accounts receivable, they normally result from the sales on credit. Normally get the sales on credit. So a company normally sell on credit due to the following reasons. So why we could sell goods on credit. Number one is that in order to increase their sales volume. Number one is in order to increase their sales volume. Then number two is that in order to avoid stock from getting out of fashion. We also sell on credit to avoid stock from getting out of fashion. Number three, in order to maintain existing customers and acquire other new customers. We are now on page 6. Then number four is that in order to avoid fluctuations in the prices. Then finally, number 5, in order to enable customers to take advantage of the quantity discount. Then we have also mentioned that the amount of accounts receivable, the amount of the accounts receivables outstanding at any particular period depends on the following factors. At any particular period depends on the following factors. Number one will be the volume of the company's credit sales. Number two, or B, the average debtors collection period. So average debtors will involve credit risk management. So the meaning of the credit risk management, it refers to the process and controls that the company has in place to ensure efficient collection from the debtors. And it normally includes the following. Number one will be credit selection. So when it comes to credit selection, they are saying that it is the process of selecting customers who will be given the credit and determining their credit limit. Number two will be the credit standards. So for the credit standards, they have said that they are minimum acceptable standards and financial viability that a customer must have before being given the credit. Then they are saying that the traditional methods of determining the credit standards and their credit selection of the customer will involve the use of 5 C's, which include, so the 5 C's, the A is the character. So it is the assessment of the customer's honesty and integrity. Then B, our BC is capacity. It is the assessment of the customer's ability to pay. C, the C next is capital. It involves the assessment of capital resource of the customer. D, C is collateral or security. This involves evaluation of the security available for the credit. Then C is condition. The decision to give credit to the customers may be influenced by the prevailing conditions in the country. So those are now the factors of determining the credit standards of a customer. The number 3 are the credit terms. Number 3, they have mentioned something about credit terms. So when it comes to the credit terms, they have said that it involves setting out the credit period allowed and the discount offer for earlier payment. So credit terms may involve a term like, so I want you to understand that term because most of the time you will meet them in the question. So when you are given a term as 2/10 and 30, so you will be getting that term in your exams, in your questions. So what it simply means, the 2 is the discount rate, and it's normally a percentage. So that 2 will be the discount rate, and it is a percentage. 10 will be the discount period. They will give you a discount for how long? Then 30 will be the credit period. That's now the meaning of that term. When you check through the notes, they have said that, i.e., 2% discount will be offered if payment are made within 10 days, the first 10 days. Otherwise, full amount should be paid after how many days? 30. So hence, in this case, 2 is the discount rate. 10 is the discount period. And 30 will be what? The credit period. So always understand that term. We'll be getting it in some of the questions. So this one is the discount rate. It is always what? A percentage. This one is the discount period. This one will be the credit period. So it depends. If it is in days, this one should be days. If it is weeks, this one should be weeks. If it is month, it will be month. So that's now what we can get from there. So that's now number 3. When you go to number 4, they have talked about collection policy. When it comes to collection policy, they are saying that this is the company system and the procedures of collecting payments from the customers when they fall due. A company may come up with a procedure in order to determine the payment habits of the customers. When collecting the funds from the customers, a company may adopt any of the following 2 credit policies. So A is the lenient or liberal credit policy. So under this policy, lenient terms are given for a longer period. This will lead to increase in the company sales volume and also increase in the bad debts expenses. Also increase in the bad debt expenses. Then being conservative or stringent credit policy. This is where the company will sell on credit, but on a highly selective basis to those customers who have been given credit and who are financially stable. This will lead to a decrease in the company's volume and a decrease in bad debt expenses. So if you check in the last sitting, if you can be able to check in the last sitting paper, when you go to the question number 2, part B, question 2, part B. So that last sitting, when you go to August 2022, there is a question number 2, part B, where they said that distinguish between the following terms as used in finance. So we are on the Roman letter 3. You can see that Roman letter 3, they have mentioned about liberal credit policy and the conservative credit policy. So we have stated that when you are under the liberal credit policy, they are saying that under this policy, lenient terms are given for a longer period. So this will lead to increase in the company's sales volume and a decrease in bad debts expenses. Then kuna hiyo conservative or stringent credit policy. So you go through those terms. So those are now the terms that they were able to give you in respect to that portion. So when you continue with what you have been given, I've also given you financing of the accounts receivable. So how do we finance the accounts receivable? They are telling us that there are normally 2 methods of financing the accounts receivable. There are normally 2 methods of financing the accounts receivable. So invoice discounting and also factoring. Invoice discounting and also factoring. So they are saying that invoice discounting, it involves borrowing and then offering accounts receivable as security. So under this arrangement, the debtor is not notified and the risk of non-payment or default risk remains with the company. Then they have mentioned about under this arrangement, the debtor will pay directly to the company that sold goods to them on credit. Then the other one is factoring. It involves selling the accounts receivable to a third party known as a factor without the commitment. So those are now how to finance the debtors. So I've given you advantages of factoring and also disadvantages of factoring. Then there is also a difference between factoring and invoice discounting. So you read them in that portion. So then I've given you some details on that element. So what we can do now, I want us to get some questions in your past papers in relation to what we have done at that level. I want us to get some questions in your past papers in relation to what we have done at that portion. So the first question I want us to deal with . So I will start with the question for the sitting of November 2018. November 2018, question number 3, part D. So we got the question for November 2018. There is a question number 3, part D. November, mine's on page 42. So when you go to page 42, you will get the question for November 2018, question number 3, part D. So are you able to see the question about Bahati? Yeah, so they have said that Bahati Enterprise is considering amendments to its current credit policy. You have seen the question? Page 42. So they are saying that Bahati Enterprise is considering amendment in its credit policy. The firm's current annual credit sales, the current annual credit sales amounted to how much? 6 million. So current credit terms are net 30 with an average debtors collection period. With an average debtors collection period, which is given as how many days? 45 days. So the following information relates to the proposed credit policy. Number 1, credit period to be extended to net what? Net 60. The note number 2, annual sales are expected to increase by 20%. Bad debts are expected to increase from 2% to 2.5% of the annual what? Credit sales. The note number 4, credit analyst and debt collections costs are expected to increase by 84,000 per annum. Return on investment is 12%. So for every 100 shillings of sales, there is how much of variable cost? 75. So assume 1 year has got how many days? 360. So advise the management of Bahati Enterprise on whether to adopt the proposed credit policy. So what we do for that element, we simply prepare the income statement. We prepare the income statement before the change in the policy and also after the change in the policy. Then we shall come up with that. So let us see some of the key items we shall be able to analyze. Some of the key things you'll be able to analyze because it will simply be an income statement. We shall simply be preparing the income statement. So to prepare our income statement, first, there are some workings we need to do. There is some workings we need to do. So we need to get the variable cost ratio. We need to get the variable cost ratio. So variable cost ratio is supposed to be given by E divided by P. The variable cost ratio should be V divided by P. So V, are you able to see in the note number 6? Variable cost values. They have given you 70 what? 75. When the sales are 100. So P is the selling price, which is 100. Then V is the variable cost per unit, which is 75. So when you divide, you get 0.75. So that is what will be giving us the variable costs. So to get the variable cost, you simply get 0.75% of the sales, because that's what it means. Then another thing I would like you to understand, when you are calculating the average debtors, when you want to compute the average debtors. So average debtors are supposed to be given by the credit sales. Get the credit sales multiplied by average collection period, multiplied by the average collection period, multiplied by the average collection period. Then divide by the number of days in a year. Number of days in. So when you will be computing the average debtors, you simply take the credit sales multiplied by the average collection period, divided by number of days in a year, divided by the number of days in a year. So we are now preparing the income statement. You want now to prepare the income statement. You should now come up with what is supposed to be the income statement. Able to prepare. So in the income statement, we simply prepare want to see how to prepare the income statement. So in our income statement, the information before the change. Before the change and also after the change and also after the change and also after change. So we check before the change and also after the change. So we start off by the sales revenue. We start off by coming up with the sales revenue. So we start off with the sales revenue. So sales revenue were given. The sales revenue were given. The sales revenue had been given. So when you check through the question in the first paragraph, the firm's current annual credit sales amounted to how much? So there was, so I'll have 3 zeros at the top. So there are 6 million. So this one. So you have 3 zeros at the top. So after the change, I would like you to go to the note number 2. Note 2, they have said that the annual sales are expected to increase by what percent? So get 120% of the 6 million, because the current sales is 6 million. So what should be 120% of the 6 million? This one will be 7.2. So we less the variable cost. We less variable cost. So variable cost, we had calculated the variable cost ratio. It was 0.75. So get 0.75 of the cells. So 0.75 of the cells will give you the figure for the variable cost. So this first one should be which value? So this will be 4.5 minutes. And also this other one, get 0.75 multiplied by 72. So it is giving us around which figure? This one. 4. So when you subtract, you now come up with the contribution. Now, the contribution. So this first one should be which figure? This 15. Then after the change is supposed to be 18. So that is now our contribution. So after we get the contribution, if there was fixed cost, we could have subtracted the fixed cost, but it is not there. So now we less expenses. Expenses minus the expenses on that. So among the expenses, are you able to see the note number 3? There are bad debts. Among the expenses, you have the bad debts. Like that. So bad debts in the note number 3. Currently, it is 2% of the credit sales. So get 2% of 6 million. 2% of the 6 million. Get 2%. You get 120. Then, and it is changing to what percent? So get 2.5% of the 7.2 million. Sorry. Get 150. Then the next expense there is 180. So the other expense that we have there is in the note number 4. So note 4, they said that credit analysis and debt collection costs are expected to increase by how much? 84,000 per annum. So maybe I can just have it as analysis and collection costs. Analysis. So we have the analysis and collection cost. So currently it is not there because they have not been there. But they are saying it will increase by how much? It will increase by 84,000. So after the change, it will increase to 84,000. It will increase to 84,000. So if there was any discount, we could have included it, but the questioner has not given us any discount. So that's now the instrument. Then apart from that, you remember you have sold goods on credit. The customer has not paid. So the customer is keeping your money. So if we could have paid you that money, you could deposit the money in the bank to earn you interest. You see, you have given your customer goods on credit. The customer has not paid you. So if the customer has not paid you, he's keeping your money. He's keeping your money. If we could have given you that money, you could have deposited in the bank and it will be earning you interest, isn't it? So you are losing interest on the debtors. So that interest you lose, we put it under the expenses. We shall be treating it as part of it is a loss that you are going through. So we put it under expenses. So we normally refer to it as opportunity cost of the debtors. Discount in the quarter in the include. Yes. Discount in a to expenses. You see, it is a reduction in the price. Yes, you have sold goods, but you are selling at a lower price than the market price. So unless it is discount received, but this one is the discount allowed. It is normally an expense. It reduces your profit. So anything that reduces your profit, we record it under the, but we shall be getting some questions which have discounts, which have those bad debts, which have accountant expenses like that. But this one had no discount. But now I'm saying there is an item we refer to as opportunity cost. Discount received utaiweka hapo. Kama revenue. Yeah. Discount received itakuwa huko juu, you subtract the expenses. Yeah. So that now you get the net before now you subtract, so that you get the contribution before you subtract the expenses. Yeah. But most of the time, it is the discount allowed. Most of the time, even there will be some items like interest. If the question has interest expenses to be paid, you also factor it in. So this one will be opportunity cost. We shall be having opportunity cost of the debtors. Opportunity cost of the debtors. So to get the opportunity cost of the debtors, you need to get the average debtors. You need to get the average debtors. We will pair the formula of how to get the average debtors. You see from the working I've given you up there. Average debtors is supposed to be given by what? Credit sales multiplied by the average collection period, divided by the number of days in a year. So first, get that average debtors. Once you get the average debtors multiplied by the interest rate. So what do you do to get the opportunity cost of the debtors? You get first the average debtors. You take the credit sales, which is 6 million. Which is 6 million, multiplied by the average collection period. So average debtors collection period. You can see what they have given before additional information. They gave you 45 days. Are you able to see the 45 days? So multiplied by 45 days. Divided by number of days in a year in the note number 7. They said we assume there are how many days? Here on the 300 yeah. So that will give you average debtors. But interest rate is the same as return on investment in the note number 5. Are you able to see the return on investment in note 5? It is what percent? Yeah. So get that part now to give you opportunity cost of the debtors. Opportunity cost is the interest rate you are going to lose by allowing your customers to keep your goods. So get the value and see how much is it. Because there are 3 zeros at the top.
Yeah. So yes, it's
Online, you confirm that figure. What do you get? Someone to confirm that figure online. Exactly 90. So that's it is also 90. Then we do the same after the change. After the change, credit sales are 7.5. So average collection period. Average collection period. So you got the note number 1. Sorry? 7.2. So you see the note number 1. The credit period to be extended to how many, to net how many days? 60. So average collection period would now be 60. Now, they had increased from 45. So now in the note number 1, after the change, it will go to 60 days. So multiplied by 60 days, also divide by 360. That will give you the average debtors. Also get 12% of that figure. Also get 12% of that value. The average debtors, yes. It is the credit sales, which is 7.2, more by the average collection period, which after the change, it is 60 days in the note number 1. Then you divide by the number of days in a year. But the interest rate will remain the same. The 45 was before the change. Then the other one is after the change. They have said that the credit period to be, sorry?
The first one is the debtors collection, and that is the creditors.
Debtors collection period is the same as the creditors period. When you are doing the working capital cycle, yeah, it's the same thing. Where they have said that the credit period to be extended. So the people who have sold goods to on credit. Yeah. So this one will give you how much? Sorry? This one is 144. Online, I hope you are also getting 144. Are you all also getting 144? Yeah, so I would like you now to subtract these expenses, because there is no other, from the contribution. So you subtract these 3 figures from the contribution, so that you get now the earnings before the tax. So that you get the net profit before the tax, or simply the earnings before the tax. So that we come up with the earnings before the tax. So that we get the earnings before the tax. So that we come up with the earnings for the tax. So what do you get before? 1290. Na hii nyingine inakuwa ngapi? 13. So normally if the question could have given you the corporate tax, yenye nakwanga 30%, but this one they have not given you the tax. So you are supposed to less the tax, but it is not there. We have not been given the tax. So if it was there, we get 30% of this, but they did not provide. So when they have not provided, don't create your own, so that you get the earnings after the tax, or simply the net profit. So that you get the earnings after tax, or simply the net profit. So it will just remain 1290. 1392. So now they wanted you to advise whether to change the credit policy or not. So you can see it has led to increase in the profit. So the advice will be that we advise that change the credit policy. Change the credit policy. Change the credit policy as it will lead to an increase. It will lead to an increase in the profit, as it will lead to an increase in the profit, as it will lead to an increase in the profit. So you also get that increase in the profit. Get that increase in the profit. So increase in the profit, get 1392 minus 1290, like that. So to get the increase in the profit, simply take the 1392 minus 1290. That now will give you the increase. So if it was a decrease, you will not change the credit policy. If it is a decrease, you are normally advised not to change the credit policy. But when it is an increase the way it is, you are always advised to change. Yes, if it is a decrease, you will not change the credit policy. But if it is an increase, we change the credit policy. So the next question should be November 2017. The next question is supposed to be November 2017. November 2017. There is a question number 1, part D. November 2017. There is a question number 1, part D. So mine is on page 48. Mine is on page 48. November 2017. There is a question number 1, part D. There is question 1D. There is a question number 1, part D, where they say that the management of Kumbo Limited intends to change the company's credit policy from net 30 to 3/10 net 60. You see that? 3/10 net 60. If this change is effected, annual sales are expected to increase by 25% from the current level of shillings 12 million. So the proportion of bad debts is also expected to increase from 10% to 15% of the credit sales. So a new credit assistant officer will also have to be employed at a salary of 500,000 shillings per annum. If there is a change in the firm's credit policy, it is expected that 60% of the credit customers will benefit from what? Cash discount offer. Then when you go to the next page, they were also able to say that inventory level and the variable cost are, however, expected to remain constant at what percent? 20% and 40% of the annual sales, respectively. So the firm's rate of return on the investment is 14% per annum. So the corporate tax rate is 13%. So all sales are on rate, and assume there are how many days in a year? 360 days. So required, you are to advise the management on whether to do what? To adopt the new credit policy. So what you do, you simply prepare the income statement. We get before the change and also after change. If there will be an increase in the profit, we advise them to change the credit policy. If it will be a decrease, we advise them not to do it, to change. So that's now the question I want us to do. So it is almost time. Then so we have a class at 2. Today you have a class at 2, Silvia? Yeah, so maybe we meet at 2. We look at that question. Now, time here nimesonga. Tunafanya exam lini? Yeah, December. So we only have 1 month remaining. That's now why we need now to do more. So we can now meet at 2 when the other guys will be in. Then we start with that question. I will do 2 more other questions. Then we conclude with that part. So that it will now make sense. But we are finishing the working capital management. So far, you see the trend we have taken. You can be able to answer the questions in your past paper on that item, those items. Yeah, for the theory, you read the handout. You'll be able to get some details. So we can have a break. When we meet at 2, you remind me we start off with that question. So you can stop there for now.